The reason most people stay poor isn't lack of opportunity, it's lack of rationality. They make emotional decisions, they follow crowds, they avoid the math, and then they wonder why their financial life doesn't improve. But here's the secret that's not actually a secret. You can think yourself not poor by avoiding stupid mistakes. I'm not talking about positive thinking or affirmations or any of that nonsense. I'm talking about something much more fundamental. Understanding how your brain is literally programmed to make you poor, and then building systems that protect you from yourself. I've spent decades watching people make predictable financial mistakes. Not because they're stupid. Some of the smartest people I know are absolutely terrible with money. It's not stupidity, it's psychology. It's predictable patterns of human misjudgment that repeat across generations. The good news is this: once you understand the patterns, once you see how your brain is working against you, you can build defenses. You can think differently. And that different thinking will compound into a completely different financial life. Let me prove this to you with something that will make you uncomfortable. If you're keeping most of your money in a bank account, waiting for the right time to invest, you're not playing it safe. You're choosing a guaranteed loss. And I can prove it with simple arithmetic that a high school student should understand. But somehow, very smart people miss this constantly. Here's the math nobody wants to face. If inflation runs at 3% annually, and your savings account pays 0.5%, you're losing 2.5% of your purchasing power every single year. That's not a risk, that's a certainty. Over a decade, you'll lose about 25% of what that money can actually buy. Not what it says on the bank statement, but what it can do in the real world. And that's assuming inflation stays at the government's polite number of 3%. If it runs at 4% or 5%, like we've seen recently, the losses are even more catastrophic. Let me make this real for you. Imagine you have $100,000 sitting in a bank account earning 0.5%. You feel smart. You feel safe. You can see the number. It doesn't go down. But here's what's actually happening. Every year, the purchasing power of that money is eroding. Year one, you lose about $2,500 in real value. Year two, another $2,500. By year three, you've lost $7,500 in purchasing power, while the bank statement still shows $100,000. This is the most insidious part. The numbers on your statement tell you one thing, while mathematical reality is telling you something completely different. You're watching the wrong number. You're measuring nominal dollars when you should be measuring purchasing power. It's like celebrating that your car's speedometer still works, while ignoring that you're running out of gas. Now let me show you what happens over 30 years, because this is where the real damage compounds. If you keep $100,000 in cash for 30 years at 0.5% returns, you'll have about $116,140 in nominal terms. Sounds okay, right? But here's the problem. Adjusted for 3% inflation over those 30 years, That $116,140 is worth only about $48,000 in today's purchasing power. You've lost more than half. More than half of your real wealth has evaporated simply by choosing to be safe. Think about what that means. You worked hard to save $100,000. You sacrificed. You delayed gratification. You denied yourself pleasures. And 30 years later, that sacrifice bought you half of what it should have. That's not safety. That's financial destruction masquerading as responsibility. But here's where it gets really interesting. Let's take that same $100,000 and imagine you'd invested it in a simple S&P 500 index fund. Just a basic, boring, set it and forget it investment. The historical average return of the S&P 500 is about 10% per year. Some years it's up 20%. Some years it's down 15%. But over 30 years, the average works out to about 10%. So your $100,000 grows to approximately $1,744,940 in nominal terms. Now, apply that same 3% inflation adjustment. That $1,744,940 is worth about $720,000 in today's purchasing power. Let me repeat that because it's important. Same $100,000, same 30 years, same person, different decision. Cash. $48,000 in real purchasing power. Stocks. $720,000 in real purchasing power. The difference? $672,000. That's not just money. That's freedom. That's the difference between working until you're 75 and retiring at 55. That's the difference between being stressed about money constantly and sleeping well at night. That's the difference between a comfortable retirement and struggling to make ends meet. And here's what makes this even more painful. The stock path is actually less stressful once you understand it. Why? Because you don't have to do anything. You buy the index fund once, you invest it, you set up automatic contributions, and then you literally do nothing. You go live your life. Meanwhile, inflation is quietly picking. The psychology here is predictable. We humans suffer from what's called deprival superreaction tendency. We hate losing what we have more than we enjoy gaining something new. So we clutch our cash, terrified of market volatility, while inflation quietly pickpockets us year after year. We're so afraid of a 20% drawdown that might recover that we accept a guaranteed 30% loss over a decade. That's not rational. That's just expensive fear. And here's the thing. Understanding that you have this tendency doesn't make you immune to it. You don't overcome it through willpower or intelligence. You overcome it through systems. You overcome it by making decisions once, when you're thinking clearly, and then protecting yourself from changing those decisions when you're scared. Let me break down the three main psychological traps that keep people poor. Understanding these isn't academic. Understanding these is survival. First, there's social proof tendency. Everyone you know keeps money in the bank. Your parents did it. Your grandparents did it. Your friends do it. Your colleagues do it. It feels like the responsible adult thing to do. So you do it too, without examining whether it actually makes sense. We're tribal creatures. We look at what the group does and assume it must be right. But just because everyone does something doesn't make it right. During the Weimar Republic in Germany, people who kept their savings in cash were wiped out. The socially normal thing was also the financially catastrophic thing. Social proof is a terrible way to make financial decisions. Yet it's the primary driver of most financial behavior. People don't invest their money wisely. They invest it the way their friends invest it. They save the way their family saves. They make financial decisions based on what feels normal rather than what makes sense mathematically. Second, there's what I call availability bias or availability misweighing tendency. The pain of losing money in a market crash is vivid and memorable. It's on the news. People talk about it. The stories stick in your mind. Your Uncle Bob talks about how he lost 40% in 2008. Your neighbor mentions that she's terrified of stocks. You hear these stories over and over until they feel like certainties rather than temporary volatility. The quiet erosion of inflation is invisible and abstract. It doesn't make the news. Nobody talks about it at dinner parties. The stories don't stick in your mind. So you fear the wrong thing. You can see a stock drop 20% in a bad year. Sure, that's painful. But cash is guaranteed to drop 3% in a good year, and that's forever. You never get it back. The second loss is actually worse. It's permanent. It's 30% over a decade. But the first feels worse because it's vivid. That's your brain lying to you about what's actually dangerous. Third, and this is the most powerful one, is deprival superreaction tendency. We hate losing what we have so much that we'll do irrational things to avoid the feeling of loss, even if it means accepting certain loss to avoid uncertain loss. Your brain is wired for survival. For most of human history, keeping your resources close was the smart move. If you gave away your food, you might starve. If you gave away your tools, you might not survive the winter. So evolution hardwired us to be terrified of losing what we have. But that evolutionary adaptation is now working against you in the modern financial system. You're protecting your cash with an intensity born from a completely different era. Meanwhile, that protection is costing you a fortune. The solution isn't to ignore these tendencies. You can't. You're human. You'll always feel them. The solution is to know they exist. Name them when you see them. And build systems that protect you from your own psychology. This is crucial because it means you can't rely on willpower or intelligence to overcome these tendencies. You need structure. You need a system that makes the right choice automatic. Let me give you an example from my own experience. I decided long ago what percentage of my assets should be in different categories. This decision was made during calm times when I could think clearly. It was based on rational analysis of my time horizon, my risk tolerance, my knowledge, my circumstances. Then I wrote it down. I committed to it. Now, when fear comes, and it always comes, I don't make emotional decisions. I stick to the system. I rebalance when needed. I don't check prices daily. I don't let fear or greed change the plan. This isn't complicated advice. It's boring, actually. But boring and rational beats exciting and emotional over any meaningful time horizon. The tortoise beats the hare not because he's faster, but because he doesn't sprint in random directions. Now, let me introduce you to something that will shift how you think about money. There are 5 assets that are actually safer than cash. Safer in the only way that matters, preserving and growing your real purchasing power. Understanding these 5 assets is the foundation of escaping poverty thinking. First, productive businesses, which most people call stocks, though I prefer to think of them as partial ownership in actual companies. Here's the key insight. A well-run business with pricing power naturally adjusts for inflation. Think about Coca-Cola. When inflation hits, Coca-Cola doesn't just sit there, losing value like a dollar bill. It raises prices. Its earnings grow. The value of your ownership grows with it. Now, I'm not saying buy just any stock. Most stocks are overpriced most of the time, and most investors are their own worst enemies. But owning pieces of great businesses, companies with strong brands, low capital requirements, and pricing power is fundamentally different from holding cash. The math is straightforward. Over the past century, stocks have returned about 10% annually, while inflation averaged about 3%. That's a real return of 7%. Cash has returned essentially zero real return, and often negative. But here's what you must understand about your circle of competence. If you don't understand businesses, if you can't read a financial statement, if you panic and sell during downturns, then stocks aren't safer for you. You'll make them dangerous through your own behavior. This is where most investment advice goes wrong. People give universal prescriptions without accounting for the biggest variable, your own psychology and knowledge. Know what you know. More importantly, know what you don't know. Second, productive real estate. Notice I said productive, not just any property, but property that generates income. A rental property that throws off cash flow is a productive asset, just like a business. Real estate has several advantages in an inflationary environment. Rents tend to rise with inflation. The mortgage, if you have one, stays fixed. You're paying back cheaper dollars over time. And the underlying asset often appreciates as construction costs rise. But again, circle of competence matters. Being a landlord is work. It requires judgment, maintenance, tenant selection. If you don't know what you're doing, you'll buy the wrong property at the wrong price and wonder why real estate doesn't work for you. I've owned plenty of real estate through my company, but always as productive assets. Buildings that businesses operate from, land that serves a purpose. Never speculation, always production. There's a crucial difference. Here's a test for any real estate investment. If the property stopped appreciating tomorrow, would you still want to own it based on the income it generates? If the answer is no, you're speculating, not investing. And speculation is just another form of gambling. Third, yourself, your skills, your earning power. This is the one asset everyone has, and it's criminally underinvested. Benjamin Franklin understood this. He said, "An investment in knowledge pays the best interest." Here's why this matters. If you have $50,000 sitting in a bank account and you're early in your career, you might be making a terrible mistake. That money could fund education, training, or starting a business that multiplies your earning power tenfold. I've watched people scrimp and save, proud of their cash cushion, while their skills become obsolete. They're so focused on protecting what they have that they ignore the opportunity to become more valuable. That's backward thinking. Your earning power is the present value of all your future earnings. If you can increase that by 20% through better skills, you've created far more value than you could by investing that money in any asset. And unlike stocks, your skills can't be taken away by market crashes. But, and this is important, investing in yourself only works if you're honest about what skills actually matter. Learning underwater basket weaving doesn't count. Learn skills that create value for others, that are hard to replicate, that match real market demand. I spent my life learning across multiple disciplines: law, mathematics, psychology, physics, business. Not because I wanted to impress anyone, but because solving complex problems requires tools from different toolboxes. You can't build a house with just a hammer. Fourth, high-quality bonds in specific situations. Notice I said high quality in specific situations, not just any bonds, and certainly not most bonds in today's environment. Here's the mental model. A bond is a promise to pay you money in the future. The question is, what will that money be worth when you get it? If you buy a 30-year bond yielding 4%, and inflation runs at 3%, you're barely ahead, and you've locked up your money for 3 decades. But short-term bonds from credit-worthy entities can serve a purpose. They're not there to make you rich. They're there to give you optionality, keeping your powder dry for when genuine opportunities appear while still earning something better than cash. Think of bonds as a temporary parking place, not a destination. The mistake people make is treating bonds as safety when they're really just slightly less cash-like than cash. In a high inflation environment, bonds can be just as dangerous as cash, sometimes more so because they lock you in. Here's the rule. If a bond's yield doesn't significantly exceed expected inflation, you're volunteering to lose purchasing power in slow motion. At least with cash, you maintain liquidity. Bad bonds give you all the downsides of cash with none of the flexibility. Fifth, useful hard assets. Things that hold value because they're valuable to humans, not just because we agree they are. This is different from speculation in gold or cryptocurrency. I'm talking about assets like productive land, machinery that generates income, or even a reliable vehicle if it enables you to earn money. These are things that do something, that serve a function, that would still matter even if the financial system had a heart attack. Now let me be clear about gold. A lot of people think gold is the answer to inflation. But gold just sits there. It doesn't produce anything. It doesn't throw off earnings. You buy it hoping someone will pay you more for it later. That's not investing. That's speculation with an ancient pedigree. We could take all the gold ever mined, form it into a cube, and it wouldn't produce anything except the need for more security guards. Meanwhile, with the same amount of money, you could buy businesses that generate billions in earnings every year. Which sounds smarter to you? Hard assets only make sense if they're productive. A farm that grows crops, not farmland you're hoping to flip. Tools that enable you to build things, not collectibles you pray will appreciate. Function over hope, always. The common thread in all 5 assets is this: they do something. Businesses produce goods and services. Real estate houses people. Skills enable you to create value. Even bonds, when chosen wisely, provide optionality. They're active, not passive. Cash is passive. It just sits there, slowly rotting in real terms, waiting for you to do something with it. The question isn't whether cash has a role. Of course it does, for near-term needs and opportunistic flexibility. The question is whether it deserves to be your main strategy. Now let me give you a framework for thinking about your own situation, because I can't tell you exactly what to do. I don't know your circumstances, your knowledge, your temperament, but I can give you the questions to ask. These are the questions that will set you free. First question: what is my circle of competence? What do I actually understand? This is the most important question because it determines everything else. If you understand businesses, maybe you hold mostly stocks. If you understand real estate, maybe that's your focus. If you don't understand either, maybe you focus on low-cost index funds and developing your skills. The worst financial mistakes happen when people invest in things they don't understand. They buy complicated financial products they can't evaluate. They get convinced by smooth-talking advisors to buy things they don't comprehend. Then, when trouble comes, they panic and sell at the worst time. Know your circle of competence. Stay within it. Only expand it slowly, with deliberation. Second question: what is my true risk? Not the volatility I see on a screen, but the chance I won't have enough purchasing power to live the life I want. For most people, the true risk is inflation destroying their savings, not a temporary market decline. Yes, stocks drop 20% occasionally, but they recover. They always have. Meanwhile, cash is guaranteed to lose 3% per year to inflation. That's certainty. Markets recover. Inflation never does. The math is clear about which is actually riskier. Third question: what is my time horizon? If you need the money in 6 months, fine. Keep it in cash. You have no choice. But if you don't need it for 10 years, 20 years, 20 years, why would you choose an asset guaranteed to lose value over that period? Your time horizon changes what's appropriate. A 20-year-old investing for retirement in 45 years should have a completely different asset allocation than a 75-year-old who needs the money next year. Know your time horizon. Base your decisions on it.
Write it down. Make it specific.
80% in low-cost stock index funds, 15% in real estate, 5% in bonds and cash is good. I'll invest wisely is not. Specificity is power because it removes decision-making from emotional moments. When the market crashes and you're scared, you don't have to make a new decision. You already know what your allocation is. You just rebalance to it. Step 5. Set up automatic investments. Don't rely on willpower. Don't rely on remembering to invest. Set it up so that money automatically goes from your paycheck into your investments. If you're paid on Friday, set the automatic investment for Monday. By the time you see the money, it's already invested. This removes temptation. You can't spend what you don't see. This is how the wealthiest people in the world invest. They automate it. They don't think about it. It just happens. Step 6. Increase your earning power. This is not optional if you're serious about escaping the poverty mindset. Start learning a skill that will increase your income. It might take 6 months. It might take 2 years. But if you can increase your earning power by 10%, 20%, 30%, you've created far more value than you could by investing. You've increased the amount you can invest. You've increased your options. You've increased your security. Your earning power is your most important asset, especially early in your career. Step 7. Join a community. Find people who think about money rationally. This sounds simple, but it's powerful. Your environment shapes your thinking. If everyone around you is chasing crypto and day trading and trying to get rich quick, you'll feel pressure to do the same. If everyone around you is investing in index funds and focusing on building skills and playing the long game, you'll naturally do the same. You don't have to find new friends. Just find online communities or investment clubs or finance-focused groups where people are thinking long-term. Step 8. Review quarterly, but don't obsess. Look at your numbers 4 times per year. Make sure things are on track. Make sure you haven't drifted from your allocation. But don't check daily. Don't obsess. Obsessing leads to emotional decisions. Quarterly reviews provide enough information without creating anxiety. Step 9. Adjust as life changes. Your allocation might need to change when you get married, have children, start a business, or get close to retirement. That's okay. Adjust intentionally based on changed circumstances. Don't adjust based on fear or excitement. Don't adjust because the market had a good year or a bad year. Step 10. Teach someone else. This is where the real learning happens. When you explain these concepts to someone else, you internalize them deeply. Teach your spouse. Teach your kids. Teach your friends. Teaching forces you to think clearly about what you know and don't know. It's the final step in truly understanding something. Now, let me close with something that will make you uncomfortable. The reason most people stay poor isn't lack of opportunity. It's lack of rationality. It's not lack of opportunity. It's not bad luck. It's not disadvantage. It's lack of rationality. They make emotional decisions. They follow crowds. They avoid the math. They avoid the hard conversations with themselves about their own psychology. And then they wonder why their financial life doesn't improve. You cannot think yourself rich through positive thinking, or affirmations, or any of that nonsense. But you can think yourself not poor by avoiding stupid mistakes, by understanding the power of compound interest, by not volunteering to lose purchasing power, by building systems that protect you from your own psychology. I'm not rich because I'm a genius. I'm not rich because I got lucky. I'm rich because I'm rational, patient, and I don't do stupid things consistently over many decades. I don't panic sell. I don't chase hot trends. I don't confuse activity with accomplishment. I just try to not be an idiot consistently. That's it. And the power of this approach is that it's accessible to anyone. You don't need a high IQ. You don't need insider information. You don't need luck.
Now, let me close with something that will make you uncomfortable.
The reason most people stay poor isn't lack of opportunity. It's lack of rationality. It's not lack of opportunity. It's not bad luck. It's not disadvantage. It's lack of rationality. They make emotional decisions. They follow crowds. They avoid the math. They avoid the hard conversations with themselves about their own psychology. And then they wonder why their financial life doesn't improve. You cannot think yourself rich through positive thinking or affirmations or any of that nonsense. But you can think yourself not poor by avoiding stupid mistakes, by understanding the power of compound interest, by not volunteering to lose purchasing power, by building systems that protect you from your own psychology. I'm not rich because I'm a genius. I'm not rich because I got lucky. I'm rich because I'm rational, patient, and I don't do stupid things consistently over many decades. I don't panic sell. I don't chase hot trends. I don't confuse activity with accomplishment. I just try to not be an idiot consistently. That's it. And the power of this approach is that it's accessible to anyone. You don't need a high IQ. You don't need insider information. You don't need luck. You just need rationality, honesty with yourself, and patience. Those three things beat brilliance nearly every time. The choice is yours. You can keep your money in cash, watching it slowly lose value, feeling safe while getting poorer. You feel safe in the moment. Or you can invest rationally in productive assets, experience volatility, and build real wealth over time. One feels safe. One is safe. They're not the same thing. You can continue making emotional financial decisions based on fear and social proof, or you can start making rational decisions based on math and long-term thinking. You can avoid looking at your actual numbers and pretend everything is fine, or you can get brutally honest with yourself about where you are and where you're heading. You can hope that things work out, or you can build systems that make things work out through pure mathematics and time. The world rewards rationality in the long run, even though it often rewards irrationality in the short run. Irrationality can make you money for a while, but rationality over time builds actual wealth. The poverty mindset isn't about how much money you have. It's about how you think about money. It's about believing that being safe is more important than being smart. It's about following the crowd instead of thinking for yourself. It's about avoiding the math instead of facing it. But changing how you think about money is the easiest thing in the world once you decide to do it. It doesn't require special knowledge. It doesn't require a new job. It doesn't require winning the lottery. It just requires deciding to think differently, deciding to face the numbers, deciding to build systems, deciding to be patient, deciding to be rational when irrationality feels safer. That's the real secret. Not some magic formula, not some investment hack. Just disciplined rationality applied consistently over time. So here's my challenge to you. Go write down those 5 questions. Look at your actual numbers. Build your system. Set up your automatic investments. Start increasing your earning power. Do these things and come back in 1 year. Track your progress. Look at your numbers. See what consistency and rationality have built. I guarantee you'll be shocked. Not because the returns are higher than expected, but because the progress is so clear when you actually measure it. Because the momentum is so undeniable when you actually apply the system. Because the poverty mindset loses its grip the moment you see the math working in your favor. So don't stay poor. Not because you lack opportunity, but because you now understand the rationality required to escape. The choice is yours. The time is now. Go build your escape plan today.